Gold ETFs are everywhere, but not all of them are built the same. Today, we're breaking down the SPDR Gold MiniShares Trust, ticker GLDM, and why it exists in the first place. If you've ever looked at GLD and thought, I want gold exposure, but I want it cheaper, simpler, or easier to size, GLDM is one of the main answers the market created. This is the ETF Investor, and by the end of this video, you'll know exactly what GLDM tracks, what makes it different from GLD, and the key details that actually matter before you hit buy. GLDM is a physically backed gold ETF. That's the headline. It's designed to track the spot price of gold minus the fund's expenses and liabilities by holding real gold bars in secure vaults in London. In other words, you're not buying gold miners, you're not buying futures contracts, and you're not making a bet on some company's management team. You're getting direct exposure to the price of gold through a fund that holds the metal. So if gold moves up, GLDM should move up along with it. If gold moves down, GLDM moves down. Over time, it will typically lag the spot price a bit because of expenses. That's the trade-off for convenience, liquidity, and being able to buy gold exposure in a brokerage account with one ticker. Now here's the question most investors ask next. If GLDM is basically gold in a wrapper, why does it exist when GLD already exists? Great question. GLDM is essentially a streamlined alternative to State Street's bigger, older product, GLD, with a couple of meaningful differences that can matter depending on how you invest. The first difference is the share handle, meaning how much gold each share represents. GLDM holds a smaller amount of gold per share than GLD, closer to what you'll see with competitor products like IAU. For a lot of investors, this is actually a plus. A lower per-share price makes it easier to place smaller orders, size positions more precisely, and dollar-cost average without feeling like you're forced into big jumps. If you're investing with small increments, that can feel smoother. If you're putting $10 or $20 into gold exposure at a time, the ability to buy shares more granularly matters. But there's also a potential downside, and it depends on your brokerage. If you're paying per-share commissions, buying more shares to reach the same exposure can increase costs. Most brokers today are commission-free for ETFs, but if you're not, it's a real consideration. The second difference is expense ratios can differ between GLDM and GLD, and in a product designed to track a commodity, vaults are not a minor detail. Over long periods, even small differences in fees show up directly in returns because you're not getting earnings growth like a stock. You're essentially paying for storage, security, administration, and the trust structure. So when you compare gold ETFs, you should absolutely compare expense ratios and tracking quality. Another nuance investors sometimes ignore is custody and vaulting. GLDM holds gold in London vaults, and differences in custodian arrangements or vault location are worth being aware of, especially if you care about operational structure, audits, and how the fund handles metal storage. Most of the time, investors won't notice a difference day to day, but it's part of the due diligence picture if you're making gold a meaningful allocation. Now let's talk about the big misconception. People often assume a gold ETF is automatically safe. Gold can be a diversifier, and it can behave differently than stocks and bonds, especially during stress periods. But gold itself is not low volatility. It can move sharply based on real interest rates, the US dollar, inflation expectations, geopolitical risk, and shifts in investor sentiment. So the real value of GLDM is not that it eliminates risk, but that it offers a clean way to access gold's role in a portfolio. Investors commonly use gold exposure as a hedge, a diversifier, or a small allocation designed to reduce overall portfolio correlation. It's rarely meant to be the engine of returns. It's more like an insurance-like diversifier that may show its value when other assets are struggling. Now we need to hit one of the most important details that catches investors off guard: taxes. Like most physically backed gold ETFs, GLDM is treated as a collectible for U.S. tax purposes. That means long-term gains can be taxed at a higher maximum rate than typical stock ETFs. So even if you're a buy-and-hold investor, your after-tax return can look worse than you expected compared to equity ETFs. This is not a reason to avoid GLDM outright, but it is a reason to be intentional about where you hold it, like whether you're using a taxable account or a tax-advantaged account. So who is GLDM best for? GLDM makes the most sense for investors who want simple, physically backed gold exposure with a share structure that's easy to position size, and who care about costs relative to the bigger GLD product. It's a straightforward tool for getting gold into a portfolio without dealing with storage, insurance, or physical delivery logistics. Who is it not for? If you're looking for income, gold ETFs don't generate yield. If you're looking for equity-like compounding growth, gold is not designed for that. And if you're trading frequently, you should understand that gold can be choppy and headline-driven. This is a tool for exposure, not a guaranteed hedge. The bottom line is this. GLDM is a clean, physically backed way to track the spot price of gold, minus fees, with a smaller per-share gold amount than GLD and potentially different expenses. If you're comparing gold ETFs, focus on what actually drives outcomes: fees, tracking quality, liquidity, and tax treatment. GLDM can be an excellent option, but only if it fits your goal for owning gold in the first place. If you want, comment GLDM versus GLD, and I'll do a direct head-to-head breakdown next. And if this helped, subscribe to the ETF Investor for more ETF reality checks. No hype, just the mechanics that matter.